Thanks for joining us for the Executive Series. Today I'm talking to Kevin Bertoli from PM Capital, who is a portfolio manager there, and he manages the Asian Opportunities Fund, and that's got a ticker of PAF. Kevin, thanks for your time today.
Thank you for having me.
Now, let's talk about the situation in Asia. Where do you tend to focus your greatest interest?
We've got a pan-Asia universe. So basically, what we're not trying to do is focus kind of top-down. So we're not saying we want to invest in the Chinese market or the Indian market. We're essentially looking for opportunities from the bottom up. So really looking at individual businesses. So typically what we tend to do, look at what we've found works globally. One of the big themes in our portfolio today is that e-commerce classifieds thematic. We've seen those businesses be very successful here in the domestic market, also in the US and Europe. We found those businesses in an Asian context as well, but at much earlier stages in their economic life cycle. But particularly one of the things we're looking at in Asia is the development of that consumer over time, and that's where we're trying to focus our time when we're looking for those bottom-up ideas.
And that's quite an important theme in Asia at the moment, particularly in China, where the economy is being transitioned away from an industrial facing one to very much being focused on the consumer.
Yeah, I think that's correct, and I think it's very important for Australian investors, because if we look at the opportunity subset in Asia 10 years ago, 5 years ago, it was that fixed asset investment story that you mentioned, and the best ways to play that was buying BHP, buying Rio, two lowest cost iron ore miners in the world. Going forward, as the transition to consumption occurs, the opportunity subset is one that's very much domestic. Buying the local player at the end of the day will most likely be the best alternative. So we really view that transition as one that will happen over a 10, 15, 20-year time period. If you look at the Australian government statistics, they have a fantastic paper that they put out in 2010 which talks about the development of the middle income earning category globally. And basically between 2010 and 2030, Asia's adding about 2.5 billion middle income earners. That's greater than the entire pool of middle income earners today. So it's a huge opportunity.
It's pretty compelling. And amidst that, do you focus on any particular industries, or it's really like what you get presented with as an investment case?
Yeah, we're fairly picky in what we invest in. So we're typically looking for businesses that dominate their industry. So we tend to be focused in ones where you have strong number one, number two players who can display pricing power over time, who can capture a lot of the volume growth. What we tend not to be invested in is commodity industries. When I say commodity industries, I mean things like, say, steel industry. We would look at things like the iron ore industry, because the reality is there's two players that control a very large part of that market, and if the price is right, they tend to do very well. So really we look at the business and try and determine whether or not that business can benefit from the structural reform that happens over a longer period of time.
Okay, so that reform that you're talking about is moving these economies to be more consumer-facing. Mm-hmm. Do you regard this as being an opportune time to be an investor in that regard?
I think it's a good time today. People have been talking about the Asian consumption story for several years, but if you go back 18, 24 months ago, a lot of that expectation was priced in. Consumer businesses, the ones that were benefiting from that consumption boom, were trading at relatively hefty multiples, 25, 30 times forward earnings, and expectations for earnings growth were 10 to 15% for a lot of those businesses. If you fast forward to where we are today, those multiples have come down to high teens PE multiples, and growth expectations have actually been rebased. So we think that's a great starting point to look at what we think is probably the best growth opportunity globally over the next couple of decades.
Now, the Asian markets in particular have been quite volatile over the course of the last 9 months, and that has been obviously a reflection of expectations around economic outcomes.
Yes.
How are you seeing things now compared to 9 months ago?
Well, I think it's an interesting point, because if you look at the last 12 months, I think you've had a direct 180 reversal in people's expectations. You go back to May last year, I was up in China, and it was amazing the expectations people had for the government-led recovery in that particular economy. But when you actually looked at the underlying fundamentals of the economy, they were telling you a totally different story. I mean, we fast forward to today, and that's reversed. People are fairly pessimistic. Asia's had net capital outflows in 2015 that were greater than the GFC period. And valuations are at record lows. If you actually look at a price to book multiple for the index, there's only 3 points in the last 15 years where it's been cheaper. The Asian financial crisis, the SARS crisis in 2003, 2004, and the GFC. So again, expectations have been rebased dramatically, and that's really, as long-term investors, what we're looking for. We're looking for short-term cyclical factors in market that allow us to buy our longer-term thematics.
And how much comfort have you taken from government initiatives that seem to be getting a lot more traction as far as China's concerned lately?
Yeah, I think one of the ones that stands out to me as being the correct approach has been currency reform. Managing their currency to a basket works far better than being pegged purely to the US dollar. Essentially, if you look at China versus their trading partners and their competitors, you've basically seen a net change of, say, 30% as other emerging market currencies have devalued and they've stayed flat versus the US. So I think that's a positive. When I look at what's happened in the last couple of months in terms of stimulus and basically improving the liquidity in the system, I worry about that because I believe the economic transition needs to occur sooner than later. And if you keep pushing that D-Day out, I think that's probably a worse outcome for the region as a whole, and particularly China. They have to make the hard decisions today, and then we'll get through the lumpy period quicker.
Kevin, great insights. Thanks for your time today.
Thanks, Tom.
And thanks for joining us for the Executive Series.